Hey, my name's Braeden Anderson, and I'm a partner at Gesmer Updegrove. I've been practicing in the digital asset and blockchain space since about 2018, and since then, it's been a wild ride, right? For years, many blockchain projects have been trying to avoid being treated as securities, many of which I've advised amid kind of uncertain regulatory signals. And while that made sense at the time, times are changing. There's a massive opportunity in front of us right now with the current SEC and the posture. And so I think now is an appropriate time to really walk through how the regulated path can unlock credible distribution through broker-dealers, qualified custody, permission transfers, and access to compliant secondary venues. It's also a strategic gating exercise because the licenses, the controls, the documentation required to operate as a regulated business in this space create a real barrier to entry. The existence of that framework, so registrations where required, transfer agent integration, AML and KYC, custody, surveillance, that becomes an asset because it makes you more credible as a counterparty to major banks, market infrastructure providers. It can also make your platform a more attractive target for strategic partnerships or acquisitions. It can also make you more attractive to prospective shareholders and investors. So now, obviously, this isn't the right path for everyone, and we have to align this regulatory framework with your vision as a founder. But my personal opinion is that more builders in the blockchain space should consider at least a regulatory framework that involves some securities exposure or a lot of it when the product, investor base, and the roadmap actually warrant that. So let's start with some of the basics. So looking back, a certificated security is kind of the traditional paper certificate that must be presented or endorsed to transfer ownership. Most markets now use uncertificated or book entry securities where the official owner is the one recorded by the transfer agent. A tokenized security is still a security. It's simply represented on a blockchain. So tokenization does not change the legal analysis. In current implementations, some issuers use blockchain within transfer agent systems. Some publish read-only, mirror on-chain, and some enable on-chain transfer between eligible holders while the transfer agent reconciles the official register. While the term digitally native security is often used by proponents of the industry to describe blockchain-based securities, in practice, existing frameworks tend to rely on regulated intermediaries and transfer agents who maintain parallel off-chain records and perform compliance functions. As a result, building a regulated product in this space typically involves implementing a hybrid structure where the blockchain serves as the record-keeping layer, but legal title and regulatory compliance are still maintained, duplicated, if you will, to comply with traditional state and federal systems of corporate and securities laws. That could change in the future. Lots of cool things happening. The market is evolving, but that's where things are today. The first foundational step is to choose an issuer structure that scales and keeps responsibilities clear. So common options typically include a GP-LP kind of fund model, maybe a Delaware Series LLC, traditional LLC, C Corp, or a statutory trust. Let's map this out in a general way. So first, the issuer offers the security. Second, a registered transfer agent registered with the SEC or the appropriate federal banking regulator maintains the authoritative holder record. 3, a qualified custodian, bank, trust, broker-dealer, safeguards the tokens and related cash. 4, if secondary trading is offered, transactions occur on an ATS operated by an SEC-registered FINRA member broker-dealer or on a registered national security exchange, with the transfer agent reconciling each trade. And so the next step after you have that kind of model baked in, right, is thinking about what is the offering route after you've defined your investor base, right? So one could be Reg D, It fits accredited investors and imposes restrictions on resale. Reg A is also an option, that supports broader retail participation with more disclosure and ongoing reporting obligations. Number 3 could be Reg S. Reg S is another option that addresses offshore investors. Also, Reg CF, the crowdfunding regulation, that allows you to raise capital from retail investors through a registered funding portal or broker-dealer, and that's subject to several limitations, which we won't get into here. So now, there are a few different types within those offering categories, but generally speaking, your offering choice here is gonna determine how much you can raise, who can buy, how transfers are controlled, and what you must disclose. Once you have decided on the type of offering, we need to establish transferability and how that will work at issuance and over time. Under restricted offerings, you should enforce holding periods, eligibility, and geography of holders through whitelisting and other token controls, and you should synchronize every transfer with the transfer agent. If you plan for secondary liquidity, you need to consider partnering with or establishing an ATS that can onboard eligible investors and coordinate with your transfer agent. Open-end daily NAV structures generally don't really fit the negotiated secondary trading model without some type of specialized relief. So many teams begin with a close-end or interval design. Next is to adopt a custody posture that is realistic at scale. So a qualified third-party custodian is typically the most straightforward path for launch. The transfer agent remains the source of truth for ownership, regardless of on-chain movement, but there are several companies that do integrate well with blockchain that we can talk about. Your onboarding and compliance program has to be built around your payment rails. So if you accept fiat, stable coins, or both, you're gonna need a robust AML and sanctions controls, program ongoing monitoring, independent testing. The handling of funds and conversions can also trigger federal money service obligations and state money transmitter licensing. And in some jurisdictions, there's further specialized licenses that cover virtual asset activity and securities custody that could apply as well. Vendor due diligence is also going to be something to consider if you are looking to outsource any of those functions. Finally, choose a tech stack that regulated partners can support and that they're gonna like. So widely adopted ecosystems and security token standards, they're widely available. Ethereum has a pretty good one, that will allow you to encode whitelisting lockups, emergency controls, and equally important, your contracts, wherever possible, should integrate transfer agent systems, custodians, trading venues. And so that way on-chain events line up with off-chain books and records. Some mature companies may be in a position to build bespoke and kind of virtually integrated systems that limit third-party risks. But if you're a startup and you don't have the capital and wherewithal to do that, there's ways that we can bring in third parties to fill some of those gaps. But there's pros and cons to that approach. The bottom line is that digital asset securities work best when legal, market, and technical controls are aligned from day one. So if you define the investor base and then you pick the right exemption and then you separate core rules and then you use standards that partners can support, you can operate on modern rails, aka blockchain digital assets, right, without sacrificing compliance or investor protection. Now, to learn more or discuss an ongoing project, please reach out to me. My name is Braeden Anderson. I'm a partner at Gesmer Updegrove. I'd love to talk to you and learn more about what you're working on.